Back in 2020, during one of our customer visits to assess the financial needs of lower-income households in rural Pakistan, I met Khalda. Khalda is a 45-year-old mother of three who runs a small home-based embroidery business that provides her an inconsistent income stream to support her family. Her husband is a factory worker whose daily wage barely covers the expenses. As I was learning about Khalda's lifestyle, I asked her about her aspirations. She responded, "Dreams are too expensive. We cannot afford to dream." Like Khalda, every second person in Pakistan is deprived of basic financial services. That's over 100 million people. These people live on the edge of disaster and frequently fall into it. Any emergency impairs their ability to meet their day-to-day needs. My experience of working on ground in microfinance has shown me what poverty means firsthand, from compromised health to lack of opportunities for education and no means to fund emergencies, resulting in debt traps, where generations remain stuck in the poverty cycle. Access to something as small as 1,000 rupees could help them cope in times of financial difficulty, and it could help them pay for something as basic as food, as essential as medicine, as empowering as a school fee. These people are financially excluded. So what is financial inclusion? As per the World Bank, financial inclusion means that individuals and businesses have access to useful and affordable financial services that can meet their needs, be it the ability to store or transfer money, access credit when they need the money, or even protect themselves from financial shocks using tools like insurance. Financial inclusion is a multifaceted phenomena that is misunderstood by many. It entails three core stages: access, usage, and freedom. Many interpret financial inclusion as owning a bank account, which in fact is the first stage of inclusion. Access to bank account allows people to store money and send and receive payments. In Pakistan, approximately 60% people own a bank account of any sort, and that includes something like a mobile wallet. Now, the gender gap, which is very stark, only 39% women have a bank account. In every region and income classification, the core reason that has been cited by these people for not having financial services is lack of money. The second most common reason is the reason why they lack accounts is that they have access to financial services through their family members. Nonetheless, more than 20% of excluded groups report the cost of services, distance to a bank branch, mistrust in the formal financial system, and documentation requirements as the core reasons for why they do not have financial services. In case of women, societal conventions dictate that they cannot even leave their homes to go and access a bank branch or interact with the financial institution. Resultantly, women, many of them, they don't even own a CNIC, which is the basic requirement for opening a bank account and using financial services. Access to an account may not necessarily mean usage of an account. As per the Global Findex, over 20% of the people in low to middle income economies who have a bank account have never used it. In Pakistan, this gap is even wider. Financially inexperienced people may not be able to benefit from bank account ownership if they do not understand how to use financial services. They do not understand how to use it in ways that would optimize benefits and avoid consumer protection risks. Now, financial inclusion is a much more expansive concept than just access. The next stage of inclusion is usage, which leads to economic empowerment. What is financial empowerment? financial empowerment is the ability to make sound financial decisions that can improve your financial well-being or your stability over time. Now, receiving payments into a bank account, it's a mere catalyst for using a bank account. It ultimately leads to relying on savings, using that account to borrow, and ultimately to store money for cash management. This is what we call usage. When we started our journey into fintech over a decade back, we saw that the financial inclusion journey is an epitome of the Maslow's hierarchy of needs, whereby human motivations generally transcend through stages of motivations that include physiological needs, to security, to esteem, and ultimately self-actualization. Financial products can be relatable to this hierarchy, whereby individuals can naturally transition from their needs, or their most basic needs of liquidity to manage their day-to-day needs, to security, and ultimately economic empowerment, where they have realizable potential to multiply their wealth through income multiplication avenues. Now, access to credit, secure savings, even efficient payments, they enable individuals and businesses to expand, to grow small businesses, to create jobs, and to drive economic empowerment. Access to insurance provides resilience in times of financial shocks, and it provides individuals with the peace of mind, and it can provide entrepreneurs with the ability to have more confidence when they undertake new ventures. Now imagine Khalda, the lady we had interviewed. Imagine her having saved for a rainy day in a bank account, having access to being able to borrow from a bank if she required funds to invest in her business, having had insurance, health insurance, for herself or her family in case of a medical emergency. She would have been financially empowered. The final stage of inclusion is financial freedom. Financial freedom means reaching a state where you can live the life you want, and you can fulfill your financial needs without any debt. Now, being able to afford the lifestyle that you like, being able to be free to travel, to pursue your hobbies, and to make a life decision without any financial stress. But that requires certain fundamentals, which all of us here should understand, because as you age and as you grow, you will understand what financial freedom really means. The first step to freedom is to set your financial goals by having an automatic cash flow and bank account system that includes your discretionary and non-discretionary expenses and your saving plans. The second step is to have a cushion or a safety net to protect you or your family in the event of a permanent or a temporary illness or a disability or even premature death. This entails allocating a certain portion of your savings into an emergency fund that usually covers something like 3 months of your expenses. The third stage is to pay off your debt, and this could include credit cards, loans, and this is slightly more nuanced. The fourth step is to invest in passive income. Now, this could entail a mix of investments in diversified asset classes, and that would completely depend on your risk appetite. This could include, a mix of cash, fixed interest, shares, or even property. And finally, handle your wealth modestly without overspending, and recalibrate your strategy as your life and goals change over time. Interestingly, most of us over here are not even financially empowered, far from being financially free. Yes, we are banked, but most of us here are underbanked, meaning people who have a bank account, but they have to resort to avenues that are informal to fulfill their financial requirements. Now, most and underbanked people in Pakistan use a variety of informal instruments to manage their financial needs, often at the risk of fraud, loss, or depreciation. The income of the people at the base of the pyramid is not only low, but it's also volatile because they depend on a range of unpredictable jobs and weather-dependent agriculture. Thinking again of Khalda, again the lady who we had interviewed, Conventional institutions do not serve people like her or her husband because they do not have credible data, they do not have documentation, suitable collaterals, enough deposit to keep the bank interested, or even access to a bank branch. Even if a traditional bank would consider serving her, the process would be time-consuming and human-intensive. In a study by the World Bank, despite promising growth in account ownership and usage around the world, half of the adult population cannot access emergency funds in times of needs in under 30 days. This time is even further away for females and for the poor people. They have to rely on friends and family to fulfill their financial needs. In the credit wave that affected thousands of borrowers in Lahore in 2009, our interviews with female borrowers revealed that amongst the first few expenses that they rolled back in times of financial difficulties were education-related, while also cutting down on the number and quality of meals in a day. I believe that the most sustainable mechanism to alleviating poverty is economic empowerment. If meaningful work is to happen towards the goal of poverty alleviation and financial inclusion, then people need to be provided with more income-generating opportunities and with greater access to financial services. In Pakistan, there are fewer than 11 branches per 100,000 adults, compared to 31 in the United States, according to the World Bank. However, the significance of bank branches is diminishing over time with the rise of the internet and mobile phone ownership. 2/3 of the global unbanked population has a mobile phone. In Pakistan, we have 193 million mobile subscribers. That's 77% of the population. Mobile money has leveraged high mobile phone penetration to provide the first wave of digital financial services around the world. As people get a mobile phone, they can get connected to a financial institution, they can create a bank account, they can access credit, they can save, or they can even get insured from the comfort of their homes. Digital financial services powered by fintech has the ability to lower costs, to increase the speed, the transparency of financial transactions, and provide more tailored services to the masses at large. Between 2022 and 24, Pakistan processed $4.6 trillion in retail payments, 84% of which came from digital avenues. Now, this growth has been propelled by proactive regulatory initiatives and investment in the fintech space. Governments, regulators, telecom operators, financial institutions, including fintechs, all could help expand financial access and usage among the unbanked by lowering barriers and improving infrastructure. This, however, requires deliberate effort to collaborate and to combine their core competencies. Financial inclusion is not an end in itself. It's a means to an end. By bringing more people and enterprises into the financial mainstream, financial inclusion, it boosts economic activity and productivity and lays the foundation for inclusive and sustainable economic growth. Recalling the words of Khalda, dreams are too expensive. We cannot afford to dream. I believe that with collaboration, we can not only give the billions of and underbanked around the world the freedom to dream, but we could also provide them with the opportunities to make those dreams a reality. So let's come together and work towards a world of hope and dignity where no one is left behind. Thank you.